Hey everyone, welcome back to another Kingscrowd Podcast. This is where we give some different investing insights in the online private markets each week. We are joined by the Kingscrowd team. Myself is Brian. I'm the VP of Product at Kingscrowd, and we are joined by some of the Kingscrowd team members. We've got Scott, and then our two senior investment associates, Leia and Teddy. On the docket for today, we're going to be talking about a couple different topics. Last week, I was actually in Washington, D.C. at the SEC's headquarters. So I'll be talking about some of the different regulations and revisions to the regulations that we are looking at, we being the industry as a whole, and what that may mean for investors. Then, in the second part of today's segment, we're going to take a look at a chart that looks at climate startups that are manufacturing in the US, powering up US manufacturing, and just the whole discussion right now around tariffs and what that may mean for those companies. All right, let's jump into the first segment. I'm going to pull in Scott here, but last week I was down in Washington, D.C. So what we were discussing with the SEC were different regulations and different capital raising factors that impact capital raising for small businesses. This was the SEC's 44th annual Small Business Forum. They invited myself to basically represent investment crowdfunding for the industry. So that's everything that was Regulation CF and Regulation A. But there was a whole bunch of other participants there as well. So they had growth stage companies, people who had raised capital from banks and different sort of different places, and then all the way through public. So they were looking at public companies that had gone public, and throughout that whole life cycle, from essentially founding to IPO, they were looking for feedback about what works and what isn't working in the online private markets and general private markets today. So my big takeaway, I think that we talked about a lot of great topics. And in terms of Reg CF, there's a lot of proposed changes that are out there. So that goes from increasing the cap instead of being able to be 5 million for every 12 months to 20 million, up to that much, as well as for Reg A, increasing the cap from a 75 million max to 150 million, to also the lower end of Reg CF. Today, it's very expensive for small businesses to raise capital. If you think about your legal costs, disclosures, everything else you have to do with your financials, that can be expensive for companies that only need to raise 50K or 100K in capital. So being able to make that more affordable was also something else that was discussed, and a bunch of other things, simplifying the regulations, investor limits, everything else. Scott, I know you've been involved in the industry for a while. I'm happy to talk more about some of what was discussed at the SEC, but what are some of the improvements or different areas for opportunity you think that exist in the industry today?
Well, first, I wanted to curious, did you get a t-shirt or anything? They give you like a SEC club shirt or something?
No t-shirt. There were some FINRA water bottles. There were some of the other different agencies that were there. I almost took one of those, but
Oh, dude, I would have taken a FINRA water bottle all day. Yeah, look, I mean, here's some things. Like, for where we currently sit in this market, and I'll lean toward just the Reg CF and individual companies raising for this. Are we feeling like we're running into I get the 5 million, but are we feeling like 72, 75 million is like a limiter? I mean, I know that there are other bigger businesses that might participate who look at it like $75 million is not enough to even get involved in, but who is filling that? And at the same time, we'll after this, so pivot to the investor side of this, because if you increase that, then you're going to have to either make it harder or make it way, way, way easier for investors to participate. Because right now I feel like we're stuck in this sort of jammy of don't have the right investors who have the ability to invest to fill a round that's that big, and don't have rounds that can be filled that big anyway.
So I think a couple of things that were talked about, even some of the SEC commissioners that were there that gave opening remarks, Scott, you're well aware of this, the IPO trends over time, right? Fewer companies are going public now, and what they want for the markets, public markets, private markets, are more opportunities for investors, right? And more disclosures to be able to get more companies out there, and having the everyday investor, the retail investor, right? Yep. To be able to have more opportunities. So is the 75 million a cap or kind of a limiter today? Not necessarily, right? Last year, if we look at the data, pulling in some of the Kingscrowd data, I think there were a handful of companies that hit the 5 million cap under Reg CF.
Yeah.
It wasn't a lot. And then there was one or two maybe that hit the 75 million limit. Obviously, Newsmax also in 2025, the recent IPO, they went public through a Reg A offering. When
That
the
I can
IPO.
see happening more often. Like that's a different thing.
Absolutely.
And like that's a whole, in just my opinion, that's a whole other category where I could envision us there being basically I mean, we would call it a secondary because of the way it's set up, but the truth is it's an exchange. We would basically be say, hey, here's like the minor league exchange. And people can come and buy, invest in, like the liquidity will always be the issue for retail. It's why a lot of the retail investors don't participate to the tune of $75 million a year per deal. They just don't want to have that kind of money tied up. And so like, I'm just curious how you are an investor, you build tech for investors, you work on, obviously trying to keep this space clean and proper. How do you look at the way that they're talking about investors in particular, what they want to do?
Yeah. So the SEC is chartered with a couple things, right? One is capital formation. So they want to make sure that it's easy for companies to be able to raise capital. The other big thing is investor protection, right? The SEC needs to make sure that people aren't going to get defrauded. Anytime that you have an opportunity where someone's raising capital, there's going to be people who are attracted to try and defraud investors, right? And then making sure there's good, healthy, functioning capital markets. So I think from my experience, again, this is just from the SEC staff that I've been talking to, they're very open to a lot of the proposed changes that would bring in more opportunities by opening up the capital markets a little bit. So it's not so much that there's a concern about fraud. If we look at the data, I think there's been one case of fraud in Reg CF to date, right? So there are plenty of organizations out there who are going to say, no, we need to restrict this more. We need to make this harder for people to invest.
There's a few I have my eye on, though. I feel like that number's about to triple.
I mean, maybe it changes, but
it's about to go from 1 to 3.
If it goes 1 to 3, that's out of 8,700, Reg CF raises. I'm sure you can probably talk to most angel groups out there, and they've probably had more fraud, like on a per deal basis than in Reg CF. So everything is a balance. And in my perspective, right, what that means is there's been so few cases of fraud that we can probably open it up a little bit more, which I think would bring better opportunities to investors. So why is that? On one side, a lot of Reg CF, I think, is still looked at by some of these issuers, by the companies that are raising capital, as being a bit of a pain, right? You got to get audited financials. It's got to be in GAAP format. And like, if you have the network and the connections, you don't have to do any of that for Reg D investors, for credit investors. You send them your data room, you meet with them in person. It can be easier. However, the downside of that is that you're not getting the same exposure you get to Reg CF. So I think there's a compromise there where there is the ability to make it more attractive for issuers by reducing some of these costs without necessarily, we're not going to be inviting tons of fraud. It's opening it up. And the SEC seems open to that. And I think there's, even if you look at a lot of the bills that are being proposed in Congress right now and through the House Financial Services Committee, there's Tim Scott's bill. There's some of these like empowering Main Street acts. All these things are looking to open up the capital markets. And so it is looking, I think, promising, and obviously nothing is guaranteed, right? That there will at least be some changes that will bring more opportunities, bring more awareness in there. Leah, I'm kind of curious, what do you think? Or looks like you have something to say as well.
You said, Brian, that some are advocating to increase the Reg CF max from 5 million to 20 million. And Reg A from going over to go over 75 million. But when I look at the data, it's very rare to actually see Reg CF companies that hit 5 million, go over 5 million. Even rarer to see Reg A companies that hit 75 million. I think I've come across one. There may be more, but I've seen only one. So do you think that this is really useful? What's the reasoning behind that?
Yeah, great question. So some of the advocates of the industry will tell you, right? And actually, so go back to the Kingscrowd data. Totally agree. There's been very few that hit the max in each. Even if you look at Reg A, I think I ran the data, and from Kingscrowd's data set, 80% of Reg A companies raise less than 10 million. So that's even saying if we raise the Reg CF cap to say 10 million, would those companies use Reg CF instead of Reg A? They wouldn't have to spend as much. And I think cost is a big thing for a lot of these companies, just the cost of doing these campaigns. It's not just the cost out of the gates, especially Reg A can cost, tens, if not hundreds of thousands of dollars just to launch. but it's the ongoing reporting requirements. You got to do like annual reports, and for people who have connections, it's maybe not as much of a priority.
Just go to raisepapers.com and we can take care of that for you.
Raise Papers is a business that's kind of the TurboTax for the SEC filings. So Kingscrowd Company.
Proudly. One thing that you did say there, and Leah, you touched on this as well. I think it's worth noting the difference. Like, I think there's pressure between the 5 million, 10 million CF. I feel like CF is this place that is like, probably to your point before, Brian, why there's not as much fraud. Like, I do struggle. I totally get why you'd want to raise the cap on CF. Makes total sense. Cheaper for everybody. There is part of me, though, that thinks that the CF is the least strenuous on you, audit-wise, diligence-wise. It is the most accessible, minimum investment, non-accredited, whatever you want, investment. There's a fear to me, and I would think the SEC as well, given how much they've put into this Title III over the last 15 years or so, that like, if you start upping it for 10 million, 20 million CF, like you are now exposing not a couple hundred, but like thousands, tens of thousands, perhaps, retail investors. And I think that is a scenario where one fraudulent company, or not even fraudulent, one bad outcome can sink the ship and basically ruin or muck the water for the Reg A plus combo Reg AD. And I think where I personally, so like that's one thing. I just think that's actually the conversation point. It's not about ease of investment or dollar amount. It's protection. This is where I really get interested in this topic. And I'm curious and I'm excited that you're in the position to like kind of represent the group here. I think you're going to start seeing more combo deals, which are currently very expensive. Reg A plus combo D, very expensive to run. But as you start, and we're already seeing, and we've talked about this, I in particular, ad nauseum, about the merging of public-private, the Newsmax 75 Reg A plus turned IPO is just one example of what I think you're going to start seeing as a combination of like equity and debt and being offered up to retail investors in tiers. So it's like, here's tier one accessing, 6%, 7% return on capital lent plus X% into equity. And then tier two is for those who invest over $100,000 and potentially even to tier one over $1 million, which are traditionally institutional, but the same mechanism is going on. And it's like that 100,000 investments, closer to 7.25% return on interest and also an equity kicker. And then the, $1 million+ investment is maybe at 9% return interest and, whatever. And like, in that scenario, you will see companies raising $75 million quickly because the credit component of this will be exponentially larger than the venture equity component. And I think that's the part that's still kind of, the shoe is still half on the foot, right? We see all these like revenue sharing platforms, Zen Equity, other types of platforms that are doing really well or like respective to the market doing really well. But, what's the other one?
Forage. Equities.
Forage is one I'm thinking of. Honeycomb. Honeycomb's in the credit.
Yep.
They're all still poo butt. They're all still kind of little guy. And like you've got Apollo over here, schlepping $15 billion public-private credit. And if you start opening up deals that are quote unquote AAA and they're going through vetted, like the tier one investment is going through Apollo, and tier two is going through here, and tier three is going through CF or whatever, like you're going to start seeing the money pile in. And I think because they're going to see returns, you're going to see principal return. So that to me is the part I keep my eye on. This is like when I see these numbers moving, it's like, I don't think that they're trying to make these changes with the current usage in place. I think it's more about how this prepares. And I do think that the SEC and you in particular being involved in this is important. This is kind of a critical stage because we're in this inflection point of innovation in fintech where we're talking about tokenization and RWA, and there's obviously shit coins and there's crypto, blockchain, all these different things that are going on. And you're seeing guys like Larry Fink with the 50-30-20 model we should consider and all these things. The SEC wants to remain the controlling position. They want to keep safety and and have government compliance as a piece of this. And if they make it too hard, tokenization becomes more appealing. And granted, they can slap down on tokenization, but then there's a lot of fuckery that goes on there too, that they can kind of escape this. So like they're trying to play this middle ground of like, hey, let's make it easy. Let's also protect people. And let's maybe almost incentivize the tokenizers to like do it through us first so that they're truly above board. And if they can do that, I mean, I don't have to tell anyone in this call, like if you do that, the space that we're sitting in is going to be absolutely ginormous. So I think it's a very important conversation that's taking place, I guess.
Yeah. So one of the things you touched on, right? Crypto, blockchain, kind of the huge elephant in the room that wasn't discussed that day. Now, there's been a whole bunch of crypto discussions going on at the SEC, but obviously what that looks like is potentially going to have a huge impact, like you said, on this industry, because if crypto has a different pathway, regulatory pathway that's easier, companies are going to use that, right? Instead of going through regulation crowdfunding. Or if it's regulation crowdfunding, but it's streamlined a little bit, or Reg A, something else, there are ways today that people could use those. So what that looks like, I think, is going to be really interesting. And last week, the day before, actually, I think Wednesday night, Atkins, the new SEC chair, got confirmed by the Senate. So once he is sworn in, he's someone who I think is looked at as being more crypto friendly, more pro crypto. He was, part of the SEC, a big part, a couple years ago, decades ago now, I think. But people are very excited about him coming in from the crypto perspective. So it'll be very interesting to see what he does under his leadership at the SEC in terms of what that turns into.
You also, your great point, Brian. And I think they also kind of they teased a little bit a few weeks ago when they started categorizing security versus basically speculative.
Like meme coins are not a security. The SEC made that clear, right? So, yeah.
Correct. So one way to look at that is like, oh, protective, like we're telling you that it's a bag of dung, like that's what we're telling you. But actually, what I would read into it, I actually would dismiss that. Like, we already knew that. I would hope you know that. What it means is if I am a company that's publicly traded or foresee myself in the future to be publicly traded or are lending capital or lent capital from publicly traded institutions, banks, etc., or I am a fiduciary of any capacity, it is a death swipe to be for my assets and my stock, however you obtain it, token, traditional equity, common shares, doesn't matter, to be considered a non-security. Like if I have a business that is considered this way, like it would be absolutely horrific. I mean, you enter ICO craze the minute that happens. So like, I actually think when they did that, they weren't they don't know enough and they don't want to put their name on it enough yet to say like, this is what securities are. They're taking the like, to steal something out of the old media journalism handbook. Like, what porn is, can't define it, but we all know when we see it. Like that's what they did with basically meme coins. They're like, hey, speculative, I can't tell you what total security means, so I can't tell you what it is when I see it, what it's not. And I think by doing that, that's their first draw on the line to say like, hey, we're friendly for crypto and tokenization. We want you guys to innovate. However, if you get deemed non-security, like there are massive implications on the backside of this. And that is a protective measure that doesn't need to be written into law, and it doesn't have to come with a fine. It's just literally like self-policing until we figure it out. So that to me is the first tease of where this is going. And I hope it continues. And then if they can keep that kind of, keep it in those lanes, all the stuff you're talking about and the increases in money and the protections and reduced scrutiny on retail investors, it paves the way all the way there where everyone can feel, generally safe, which is super important. I really applaud what they've been doing over the last, I would say 6 months plus.
Yeah. I mean, just being there, I have a ton of respect for the staff of the SEC because you see how many different people are there with their own agendas and they have to take all of that and come up with some recommendations. So shout out to the SEC. I know Teddy, will bring him in later, has mixed feelings sometimes in the SEC. I will make a plug for Teddy. Some of the other things we were advocating for, right? Not just the caps, making SEC documents searchable in Edgar. This has been a huge pain point of our team. We brought that up with the SEC staff, just simplifying things like investor limits. We're trying to make it better, more streamlined for investors. So you don't have to run a calculation every time you want to make a little $100 investment to figure out if you're over your 12-month limit or not. Kind of asinine. So I think stay tuned. There's going to be a lot more happening there. But thank you, Scott. Let's move on to our next segment.
Thank you, Brian.
All right, I'm going to bring Teddy and Leah back in. So, Leah, you looked at the chart this week. You were looking at climate startups that are basically powering up U.S. manufacturing. All of this within the context of everything over the past few weeks that's been happening around tariffs. This is obviously a hot topic. So I'm going to pull up my screen here. Why don't you share a little bit about what you were looking at?
Yes, as you're saying, the last couple of weeks have been pretty hectic. If you've been watching the news, so right now, at the time we're recording this, you have, about a 10% tariff on most countries around the world and 145% on China, even though it's a little bit more complex than that. By the time we will publish this video, by the time people will watch it, things might have changed. But that's the context that we have right now. And we've wondered, are there companies, startups currently raising online that could actually take advantage of this tariff volatility? Because at the end of the day, whether this tariff stay or not, there is fear related to investors, related according to whether this tariff could come back. Is that going to affect the business? And so it might be smart to invest in companies that are already planning to manufacture in the United States. So this is a non-exhaustive list, but this is kind of some of the climate tech startups that we've been looking at recently and that told us that they were building manufacturing facilities in the United States, or they already have manufacturing facilities in the United States. And so all of these are investment opportunities that are offered to investors that want to make a climate impact or that want to invest in companies that have a true product market fit with a market that is growing, a real demand, but that are also manufacturing in the US, which is not only lowering the risk, but actually giving them a competitive advantage across anybody that is manufacturing competitive products around the world. And what is even more interesting than the case of Kinetic, Sorbiforce, Helio, so they do batteries and drones, the main competitors coming from China. And we know that China is probably going to get heavily tariffed. And so that really gives a big advantage to these companies.
I'm curious, Leah, it sounds like these companies in particular had perhaps already planned to do their manufacturing in the US prior to the announcement of the tariffs. Maybe they had some suspicion, right, that some of the tariffs would be as they were. I'm just curious, do you think, will we see more companies perhaps looking? And have you seen any trends or talked to any founders who were originally planning on being outside the US now coming in? And B, do you have any ideas why these companies, for climate startups in particular, planned to manufacture in the US before even kind of the tariff announcement?
Yeah, we're talking about technological product in most cases. And so actually manufacturing in the United States bring highly qualified workforce, also access to stable grid, access to great transportation. And all of these companies are manufacturing in the United States because this is where their customers are. So it's just easier for them as well. Did they plan that? I know that for Helio, it's really a selling point because they're selling to farmers, and it's pretty important for farmers to buy US-made products. For the other companies, I don't know if that's something they projected. I think that it's easier from a logistics perspective, but it's probably smart because I think that for some of them, it's a long-term investment that was probably also being pushed a little bit by the Biden era, because we know that since COVID, with all of the logistics problem that happened related to semiconductors, we saw the price of lithium-ion batteries that really skyrocketed around 2022, and the IRA that brought subsidies to help companies manufacture climate tech related products in the United States. I think all of that, it was an incentive, and it kind of comes at the right moment. So I would say it's just a good strategy these companies have done, but I don't know if they planned it. Now, on whether I've seen other companies moving their manufacturing facilities into the United States, I think it's just too soon right now. But we have to remember that it is actually pretty costly to bring back home manufacturing facilities. It takes millions of dollars of investments. It takes years between project to being actually able to manufacture products in these plants. And so these companies have kind of an advantage because they've been planning on doing that prior to the new tariff policy.
Interesting. Yeah. I just love the ability to, showing some of these in the states they're in, investors in those states can invest in these companies, which is a pretty unique thing that Reg CF enables, right? Teddy, I know you look at a lot of different deals as well. Are you seeing any impacts, whether it's manufacturing or otherwise, just in terms of some of the tariff discussions and the uncertainty right now?
Yeah, I mean, the two industries that I like the most, you could say, is early stage pharma, med tech, as you all know, and application AI companies. Both of those were exempt from the reciprocal tariff. So pharmaceutical imports and semiconductors, amongst some other electronics, are exempt from reciprocal tariffs. The Trump administration is now probing both of those industries and is going to be creating a separate kind of tariff plan and requirement for imports for semiconductors, which is semiconductors are keyed in the NVIDIA chips. If those go up in price, you're going to see reverberations, I think, like throughout the entire chain. So you have NVIDIA, they get all their chips from Taiwan, and when they import those into the United States, if they're hit with widespread tariffs, that's going to affect companies like CoreWeave and Lambda that, create clusters of NVIDIA GPUs and then rent that server space out to AI startups, companies that using large amounts of data to train their models. So it's going to be interesting to see what the administration comes up with, because those were exempt. And this kind of started with Biden, but trying to push AI chip manufacturing into the United States, like with the $500 billion project Stargate that OpenAI is running and building out plants in Texas and some other places in the US. It's still early stages. I think it's going to take a while before chip manufacturing is like, we're kind of self-sustaining ourselves in the US with that. But I think the reciprocal tariffs on semiconductors are going to be definitely going to be seen. And on the pharmaceutical side, it's like the U.S. I think imports 72% of its APIs, so it's active pharmaceutical ingredients, from overseas, and those have also been exempt from tariffs. But the administration also looking to start implementing those separately and picking and not allowing them to be exempt anymore. So I think those are two industries I think are going to be super interesting to see how they pan out.
Yeah, I don't think anyone knows right now, and just how quickly situations keep changing. It'll be longer term impacts we'll have to probably sit and wait around for.
Yeah, a lot of these small businesses and like these tariffs kind of across the board were implemented pretty quickly and without giving businesses, especially small businesses, enough time to adjust their supply chains and kind of cope with that. And then some of them get paused. So then they're like, well, why did we adjust our business? So it needs to be stabilized at some point. And I don't know if we're near that yet, unfortunately.
Yeah. Well, thank you both for your very valuable input and expertise. I think we can wrap things up there for today. So for everyone watching this, make sure you head over to kingscrowd.com, sign up for our newsletter. You get all these great weekly insights delivered right to your inbox. You can also create a free account so you can see all these great opportunities that we are discussing and reviewing, and take a look as an investor yourself or as a founder. If you're looking to raise capital, we have tons of great data there to be able to help everyone make more data-driven decisions.